And I got into the business out of consulting, which is a fairly boring business, by asking around my classmates from business school who was having the most fun. And very sophisticated approach to career planning. And by a wide margin, the guys in the stock market were having the most fun. And one of the reasons they were having a lot of fun was that there was a super bubble in microcap. It hardly got noticed in the serious market, but the little stocks were doubling, quadrupling, and then blowing up fairly regular intervals. And a group of us in Boston from various mutual fund groups would get together for lunch. And they were old pros because they'd spent the first 2 years out of business school in the stock market, and I'd been wasting my time. And so I kept relatively quiet, listened to the conversations, and would buy the suggestion of the day and hold it for a few weeks. And one year, the story was American Raceways, and that was going to introduce Formula One Grand Prix racing, which incidentally, 50 years or so later, is now finally creeping in a little bit. But it seemed power, noise, risk, the odd death, crashes, it seemed very American to me. And American Raceways had bought one track, Michigan Speedway, and they were going to have a proper race, and they did. And because of the novelty, everyone and their dog came, and they camped out on the hillsides watching the cars racing around this track and generating the feeling that, wow, if we could have that number show up 15 times a year, we were rich. And so the stock did very well. And the first lunch, when I met it, it was $7 a share, and I bought 300 shares and went on my summer vacation. My wife's German, I'm English, so we squeezed out 3 weeks, and we went to Europe, and we came back, and it was 21. In 3 weeks, it had tripled. And I like to joke that I did what any serious value manager would do. I sold everything else I had and tripled up. So now I had 900 shares. Everything I had was in this damn stock. And it was 100 by Christmas. And we were rich. You know, we had enough money. We could have bought a nice house in England with no mortgage and a BMW, you know, that kind of comfortable amount of dough. And this was, 2 years out of business school, so I was pretty pleased with myself. And then I didn't get out, and down it went. I scrambled out. I scrambled out at 40, down from 100, and went into a similar brilliant idea, market monitor data systems, which was going to trade options. And it was putting a box, a strange looking box, where you pushed the buttons and you got the price of the option and you traded it. And it was a brilliant idea. It was just about 15 to 20 years too early. So people had the box, but there were no options. Then they had a few options, but not enough people had the box. And it was a pretty good lesson that you can be too early for the marketplace. And I scrambled out of that, paid off my leverage at the bank, and had a couple of thousand down from about 60,000. And from that day on, I tended to be much more conservative and pretty much a dedicated, serious value manager for the rest of my career. Let me say, my main interest in the market has been as a historian, and therefore I'm cursed with a much longer horizon than 99% of the players. And I've done my best to tailor to that and live with it. But as a historian, you have to say, if you look at the broad sweep of history, you have to be impressed with how incredibly bad the marketplace is as a judge of the future. So if you'll bear with me for a second, just let's go back to 1929. It's the highest PE on trailing earnings up till then in history. By today's standards, pretty modest, 21 times trailing. The earnings, however, have spiked. They've done brilliantly well. The economy is booming like it was China in its heyday, probably the most rapid period of growth in American history. Double-digit increases in industrial production, that kind of thing. And it peaked in September 1929, September, October, 21 times trailing. And how good was that? It was the highest price in American history. What was it projecting? It was projecting not just ordinary times, not just not good times. It was projecting the worst 10 years in American economic history. So you had the highest PE, the greatest bull market, not a few years before, a few days before the beginning of the biggest wipeout in fundamentals, not the stock market. Yes, the stock market went down colossally, but the economy collapsed, the global economy, international trade, currencies, everything went to hell immediately following the greatest bull market in history. So you have to ask yourself, what was the market doing that it not only couldn't see trouble coming, but it apparently saw heaven coming? It could not possibly have been more wrong. So you fast forward to Japan, which is in a way the mother and father of all bubbles. Japanese market had never sold over 25 times earnings until it did in 87. By 89, it was put to us that it was 65 times earnings. As far as we could tell, the Japanese market was 65 times trailing earnings, never having sold above 25. So it had gone up. And this is what should put the fear of God in anyone trying to time the market. It had gone up 150% more than it ever had in history. What did it predict? From the day it hit its peak in late 89, you had a lost decade, arguably a lost 20 years. The Japanese growth went from sensational to miserable. The Japanese market for 8 minutes sold at a larger value than the US market. For an economy a third as big, it was incredible. And again, we had a sensational PE, not predicting good times, but predicting the worst times that you could possibly have wished for Japan for the next 20 years. If you think about the great financial crash, it wasn't the highest PE in history, but it was pretty darned high. The other day in 08, in early 08. And again, from a very high level, third only to 1929 and 2000 tech bubble. Instead of predicting good times, it predicted the worst financial crisis in modern history, which nearly brought the entire developed world to its knees and needed the most sensational bailouts and injection of liquidity, etc., to save our bacon. Incredible. So if you look at the three great events, or three of the four great events of the 20th century, you have to say absolutely spectacularly wrong. Peak multiples projecting the worst periods of our history. Well, I often quote Hussman. I've actually never spoken to him, but he produces very good data, and it's free, which I always like. And the model that he uses that has the highest predictive value, measuring the value of the market, is slightly higher today than it was at its two previous peaks, 1929 and 2021 December, just before the fairly decent decline of 2022. And now we're slightly higher. This is on the most predictive measure of value that he has produced, and he's worked at that, as far as one can tell, constantly for 30 years. This is the most vulnerable market there has ever been.